Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark and how the credit market predicted the downturn in the equity markets. Research Inc.'s Ted Dixon comments on the futility of governments trying to protect their currencies. We talk to Ross Clark right after this.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtney, Campbell River, Surrey, Kelowna. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Ross Clark, investment advisor for CIBC Wood Gundy. Well, Ross, welcome to the show.
Always a pleasure to be here.
And the very first thing we're going to talk about is the shift in the credit markets and then the domino effect following that. We talked about this in December. Well, here we are at the end of January, and the things we talked about, it seems to me, are starting to come true.
Well, yeah, and in spades. What we've got here is this monstrous shift where, months ago everyone was worried about rising interest rates and the Treasury bond market, and what we're looking at is a 12-week low on the Treasury bond market in terms of rates. We're back down to 2.7%, on the U.S., about 2.35 in terms of Canada. How things have turned the corner here. And, if we look back, in the last half of December, some of the items started to show up in terms of when you look at the bond market, the high yield area, which had been just outperforming significantly since the March 2009 bottom in the markets, started to show divergences. It was starting to underperform relative to the high grade market and relative to the T-bond market in those last 3 or 4 weeks of the month. And so, we at that point really put out an alert and said, you got to be careful here, because if this continues, it's really of significance. And then as we got into the month of January, we saw that the easy money, the carry trade money from Japan, which had been helping to fuel equity markets around the world, that, with a reversal in the yen, basically right at the turn of the year, started to show its head. And we look at the spread of the yen versus the euro, and that turn right at the beginning of the year has been easing down right through today. There's been about a 5% move in that currency differential since the beginning of the year. But the key was that, we had seen some of these pullbacks in that spread before, but when the equity market rallies in the face of that, it's usually an indication that there's so much exuberance in there that money flow from external sources is being offset internally and locally. However, when you do see those divergences, and I guess since the bottom in 2009, we've probably seen a dozen of these, every single one of them ended up in a correction in the equity markets. And anywhere from, most of them were around the 5 to 7% level, and I think 3 of them were into double-digit levels. So by the time we got to the middle of the month, we were seeing that, and that was really, it just looked like it was going to be the catalyst for general risk-off aversion, which was so different than what we had seen at the tail end of the year. The tail end of the year, it was risk on. Everybody was enthusiastic. Sentiment as far as the markets was at extremes. You take a look at the RIDEX ratio, bull to bear asset ratio. You're sitting at like not multi-year, multi-decade extremes as far as that. So everyone was complacent, of the mindset that nothing was going to turn sour on things.
But why would they think that, considering that every time a market has done what the equity markets did, oversold, overvalued, there's always a correction that follows. We hit record highs, and after record highs, there's always a drop.
Oh, sure.
So why do people ignore that?
Well, what happens is that, you try and quantify these levels. It's, as you get more and more into a move, there's money that's been on the sidelines, hasn't participated. It wants to come in. It continues to see others making money, and they want to get on the bandwagon. And it's this transition that you see from right through all the emotions, from fear to greed, and it takes time for it all to happen. But as we moved through last year, the corrections were very, very mild from the spring on. And, there were a lot of people, including myself, who were looking for tops at various times in corrections, and each one was becoming very, very mild. One of the pieces of research that I did was to take a look at how long has it been since you were back to the 200-day moving average, or how long since you had a, quote, cycle low of, normal duration. And the stretches here between the moves back to the 200-day moving average, I took a look at the NASDAQ, just to take a look at the euphoria of the 1990s into the dot-com bubble. And there were only two other times, independent of the move that we've had in the last year, that were longer than this in terms of staying above the moving average and not correcting back to it. But, people feel they want to be on board the train while it's working, and that, quote, they'll be able to recognize the turn and get out early. Well, we all think we can do that, but in reality, the top, if it becomes a bubble, there's not a lot of time to make that decision.
And a lot of people, like you said, expected to know when the top of the market was, but nobody with any brains will say, I can predict when the market has peaked and I can tell you when to bail at just the right time.
Yeah, well, we can all pick tops. The question is picking the right one.
Yeah.
And so, there are very few people who have consistently been able to pick off major tops without having other interim ones along the way. And I think you have to take a look at your personal investment psyche and where your levels of comfort are, what you want to deal with. If markets are euphoric and running away, then for myself and clients, we like to just step back at this point and you just start taking money off the table, so that when the corrections inevitably come, because they always do, that you're prepared to take advantage of them. And the longer a move goes without a correction, the more severe it ends up being on the backside.
That's typically. I was going to say that's why so many people were complaining about quantitative easing, because it's something new thrown into the equation, and they felt, well, the longer it keeps driving the market up, the more severe the crash will be.
Right. And so then, with the first sign of, the talk of taper last May, that's when you had a significant correction. But, and the reality of it is they're still, they're tapering back. Now they've tapered twice on here, but they're still putting tremendous amount of money into the system. And so they're trying to fuel that one along. My thought, if we never had heard of QE until it happened. The question will be, once they've finished with this program, what comes next?
Well, it's almost like the U.S. military, the way they come up with new terms like collateral damage. We never heard that until the Vietnam War, hitting innocent people by accident. But the way they put it, collateral damage, makes it sound like, they broke a door or something.
Yeah.
Or a window.
And so now the U.S. government wants to start offering tax-free government bonds to the individuals. It says to me, maybe they're a little concerned about some of the foreign purchases down the road. Who's going to be buying some of that U.S. debt? Interesting.
And what would happen if China called their loans in?
Well, they don't even have to call the loans. They just have to stop rolling the paper. That's they don't want to destroy the golden goose here, because it's still the U.S. consumer is still a major part of the Chinese economy. So that's they have to work with each other. However, you could see how the Chinese might want to wean themselves off of some of these positions, and I'm sure as far as the U.S. is concerned, they still are the key player in terms of the world economy, but they've got their fair share of problems.
Are they over-dependent on China?
Well,
or is everybody?
I think everybody is.
We're addicted to their spending. But China now, late last year, the Chinese government told local governments you can't approve any more real estate projects without our permission. And we know they've built cities with nobody in them.
Right, and well, that's what happens when you don't have to re-elect people every 4 years and you can have long-term plans. However, if you get a little carried away with yourself, you end up with the gluts that they've ended up with right now. But
what's that going to do for people? I know with gold, the Chinese government pretty well bought all the physical gold last year. Gold, when people, I know they usually flee to gold when the equity markets start to go down. Is that really going to radically drive up the price because there really isn't any gold right now on the shelf to buy?
Well, for all that gold is international perspective, really it's local. Gold is it's priced in your currency wherever you are, right? I mean, if you were in Canada and your Canadian dollar went from 65 to 110, you had a real underperformance as far as gold was concerned. If you were in the U.S., it was a fabulous, really just absolutely fabulous stretch, 2005 to 2011. As I look at it, the gold is it's an insurance policy. It's a safe haven if things go awry in your local currency and where you are. Just think if you're in Turkey right here and you've had this devaluation, or Argentina with the peso. This was actually a great month to have been an owner of gold in those countries. And so it did what it should do. It protected them at times of need.
Is there going to be a greater demand for it just because the markets right now are declining?
Well, it should. We've had this inverse market since 2011. Equities, any week or more that the equities were moving up, the gold market typically was down. There was probably I would say an 85 to 90% inverse correlation to them. Now we didn't have that in the 2 or 3 years leading up to the top. We had them both moving up together because currencies were going down in value. But, you take a look at what we've had for the last 5 years now, is that the U.S. dollar is unchanged in 5 years. For all everybody says it's the weak currency, things are really bad. In reality, against the basket, it's trading within 1% of where it was 5 years ago. And the ranges actually are getting tighter and tighter to the point at this point now this is when I look at the basket, because if you look at individual currencies like the yen or the euro, yes, they've had some fairly large moves against the dollar, but against the basket, at this point, you're pretty much bound by a cap just around 83.5 and a floor at 78.75. Now, my bias is to think that this will eventually break out on the upside, and that we'll end up seeing a significant move in the dollar, but that's against other currencies. It may be that you're having a flight to quality where we had in 2008, where people are buying gold and U.S. dollars. So you can actually, at a given point, have both the dollar and the gold rising together.
More with Ross Clark next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're chatting with Ross Clark, an investment counselor at CIBC Wood Gundy. Ross, gold has always been a fascinating topic, and again, people try to guess the peaks and lows of it. Where is it going to go in the immediate future, and is it still a long-term bet to go over the $2,000 mark?
Well, I think the major trend is still up, and clearly that I would say that even if we pulled back to 750, that quote, it's still in an uptrend. That isn't what the short-term investors want to hear, but that's the reality of the big picture. I take a look at probably half a dozen ways to look here at the gold price and the miners in the bigger scheme of things from a technical perspective, because everybody can argue the fundamentals on these. But when I take a look at bubbles that we've had over the years, and if you think of this running gold up to $1,900 plus, and the tail end of that being pretty much an exponential move, those type of bubbles really stand out over time. You've got the South Sea bubble. We don't have a lot of data to take a look for that, but in the last century, there have been some very good ones that we have price data on. And if we take a look at the action of gold and silver from May of 2011 and gold from the August-September high, we're sitting at about 2.5 to just pushing 3 years right now since the top. And when we look at these other bubbles, the 1929 high to the 1932 low in the Dow, 148 weeks. The gold from its 1980 top to its bottom in 82 is 126 weeks. The Nikkei, 1990 to 92, is 137 weeks. The NASDAQ, the dot-com implosion, that was 134 weeks into 2002. This move on gold from the highs in August, September of 2011, we're currently sitting at 120 weeks to the December bottom that we put in place. So it's a normal window, but it's a little bit early for us to be looking at the backside of one of these bubbles. But the probability is that we have either seen or should have the low in place, I would suggest, by the middle of this year. That's the norm. Now, if it's something like the Nikkei, you're not looking at all-time highs again for an extended period of time. However, even the Nikkei rallied by 30% off that low. So worst case scenarios, I can see that gold initially might recover half of its probably in the next, let's say, 2 years, recovers a minimum of half of the decline that it's had from that 1900 high. If we take a look at the miners, I have data on Homestake and the Barron's Gold Mining Index going back over a century. And two means of analysis here also are pointing towards us having made some very significant lows. One of the analysts, or I shouldn't say analysts, one of the traders in the early 1900s, W.D. Gann, was caught up in cycles and other things in terms of his analysis, and he looked at these long-term 30, 60, and 90-year cycles as having major importance in terms of virtually all of the markets. And when we take a look at the mining indices, the current mining indice charts, and you look back to the 1982 bottom, 1983, going back 30 years, you go back to the December of 1954 low, to then the 1924 low for Homestake. They all had major 2-year declines into their lows, like we're just seeing now, and creating similar types of bases. So it's really intriguing from that longer term perspective. The extent of the declines are very similar. The shape of the patterns are very similar. So, as an analyst, it makes me sit up and want to identify how to turn the corner on these. And we've come up with some analysis that should be very helpful, not to determine the bottom as to whether it's in place, yes, or whether we've going to sort of pick a bottom day. The objective here is going to be in the earlier stages of the move. I would say it would be like entering the equity markets in the spring of 2009 rather than in March of 2009. As long as you are in there once the low is in place, there should be a fair amount of money to be made on the upside.
Do you think a lot of people are going to sell their shares, take the cash, wait for what they feel is as far as the correction is going to go, and then they're going to go back and buy the same shares but at a lower price.
Well, usually what happens is they sell into the first rally in a bull market, looking to buy it on a pullback, and the next pullback isn't as deep as they thought it was going to be, and then they find themselves in a bull market without a position and trying to chase it on the upside. So, I would be looking at, in terms, you want to have an idea of what to look for at the bottom. And the thing that's happened at the bottom of those other implosions is that the initial rally, you want to see it take out a key resistance. And for me, I look at a trend, and I look at, when you're in a downtrend, I want to look at the last failed rally. And the midpoint of that, to me, is the area of significance. Because if we can get up through that, I know that we're starting to take out a fair amount of the sellers, the people who had gotten out of the market, and the buyers who had come out when it broke. They may be looking to get back in. And what will happen is that when you look at these gold bottoms, like the 1976, the 1982, the 1985 bottoms, they're all similar in structure. They're what I call an isolated low, where you had a support level that was broken, which we just did in December in a marginal way. Then you rally through the midpoint of that previous resistance. And once you've taken that out, you can put a label on it to say, okay, bottom is in. And now what you want to do is buy the first 50 to 60% retracement from the bottom. So if it rallies $100, you're going to look to be a buyer on a $50 to $60 pullback. If it rallies $200, you're going to be looking to buy on a $100 to $120 pullback. That, over time, has been a very, very nice way to get in on the early stages of the next rising trend.
And of course, they always say by the time the regular person notices an uptrend or a down, it's too late.
Well,
to really take advantage of it.
Yeah, well, and what would happen here normally is that first rally, everybody gets excited about it. Once it starts to, quote, as I would say, make that turn, they get excited about it in the early stages of the first leg up. And then they get scared once it starts to sell off again and have that first point where it's coming back to test the support. That's why, I look at it and say, here's the pattern, here's the definition of the pattern, here's how I want to participate, and have appropriate stop losses so that if we're wrong and it continues to erode away, that you don't ride it all the way back down again. But, I think at this point when you look at sentiment, you've got at the bottom of the gold market, I think just under 30% bullish sentiment. We're still only around 45%. This is by historical levels, this is very low. Silver, you're sitting with about 25% bullish sentiment. Once again, a very, very low number. I think it's going to take a while for those who had been in the market and got out to be looking to get back in, or those who are already invested to look at putting new money in. There's most of these mining, so even the senior miners are down 70% off their highs. Even a double from here is nowhere near where they used to be.
Interesting times, Ross.
Oh, it always is.
Well, that's why we're on the air. Is there a website people can go to take a look at some of your advice or what you've discovered with your charts?
Well, I have a number of reports that I've done recently that if somebody wants to send an email off to me at ross.clark@cibc.ca, I'd be more than happy to send them some of the things that we've been discussing.
Thanks a lot for chatting with us.
You're more than welcome.
After the break, Ted Dixon on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ted Dixon, CEO of Inc. Research Corp. Welcome to the show.
Well, it's great to be back, Jim.
So what is happening out there? The equity markets, as predicted, would slide off as the EQ was reduced. But is that really a factor? Do we really care what the Fed is doing when it comes to doing real business?
Well, when it comes to investing in the stock market, we certainly care. In terms of the real economy, I think one has to ask whether QE has been very relevant at all to begin with. But let's focus on the economy on the market, because basically that's what we look at in terms of what the insiders are doing with their money in the market, and we try and help people at Inc. Research navigate their way through the stock market. So let's just focus on that and try and figure out, okay, what are insiders signaling here in light of this reduction in QE? And basically, the message is in the United States that corporate insiders are not signing up for this ride in terms of the reduction of QE and the latest round of money printing, and probably for good reason. Every other time the Fed has tried to reduce or has stopped reducing its stimulus, the stock market has basically gone down. So the history behind the Fed making a move to try and limit its involvement in propping up asset prices has not been a good experience, and insiders are saying, well, maybe it will work out this time, maybe everything is just fine, maybe the U.S. economy is doing great, and maybe the stock market will continue to rise. However, they're not betting on it. So it doesn't mean it can't happen. It just means that those individuals that probably have the best knowledge of their companies and their sectors are not putting new money to work right now. In fact, they're taking some money off the table. So that is something your listeners will want to consider, is the risk. So insiders don't just look at the price. They don't just look at sort of the economy. They look at the risks. And right now in the U.S., they certainly aren't betting on more stock rises. And in Canada, they're also starting to get cold feet. And oddly enough, the nervousness in Canada coincided with the drop in the Canadian dollars. So maybe there's a bit of a relationship there too. So there are a lot of developments in the market early this year, that will really could make it or break it. I mean, Jim, we really are at an important point in economic history. I mean, we all go on and do our day-to-day lives, fortunately, and do real business. But in the backdrop here, there's something very historic going on, and it's never really been tried before. So this is a bit of the unknown, so maybe it will all work out just fine. But, the operative word is maybe, and when you come to investing your own money, your retirement money, your kids' money, you have to keep in mind that this is more than just sort of the usual wall of uncertainty. This is the grand experiment, the Fed trying to come to an end, and insiders are signaling, whoa, we think we'll skip class that day, this day of the big experiment that no one's done before, and we're going to stay home and take a sick note. We'll just watch and see what happens.
Ted, we have these government experimenters with our economy. What if they said, I'll just tie my economic future to the decision I just made?
Well, that's it. We all talk about governance in the stock market, and for example, in Japan, they've just launched a new index that tries to identify companies that have basically got better corporate governance and better corporate results. But what if we did that with government officials? And if they're and the Fed, if their forecast didn't work out, that they were penalized monetarily. Wouldn't that be good? And we do a little bit of that in BC with the budget, which is great, but that's the exception than the rule, unfortunately.
That's right. Take away their bonuses if they don't meet their performances. It's pretty simple, but the world doesn't work that way.
Well, politicians and Federal Reserve and central bank officials don't work that way. I mean, if Stephen Polo's is a grand experiment here with soft talk on the Canadian dollar doesn't work out too well, he'll just we'll see what he'll do, but it won't affect his paycheck. It'll affect with the Canadian dollar going down. Of course, we all get a little poorer, and there are some winners and losers, and some manufacturers will do much better, and exporters will do much better. But price of oranges is unlikely to go down on the basis of what's happening in the Canadian dollar. So that's another sort of grand experiment here. And usually when countries try and devalue, it doesn't always necessarily work out so well. But at least in Canada, we're not actively promoting it, and we'll see what happens. But it's just another risk that's out there, and that insiders are kind of saying, well, maybe this is not exactly the kind of environment we want to be putting new cash in right now, except maybe in selected situations. There's always cases in the market where there's companies that are undervalued, there's new technologies, new innovations, new oil and gas properties that have been discovered, new mining properties that have been discovered. I mean, there's always individual situations that investors can look at. Right now, however, what we're basically interpreting from insiders is that if you're committing money to these situations, you may want to look at hedging some of these risks on the downside and just be very prudent. And hedging can be anywhere from ETF bear positions to offset some of your long positions to just holding some good old cash in case something does happen in the market and you can redeploy it cheaper. So there's different ways of everyone has different circumstances, and the key here is to be mindful of the risks that are unfolding this year and this quarter, and it's happening like right now.
Everybody said you had to pay attention. Perhaps this is the time where you really had to.
Well, and the insiders who've been selling, and in the United States, we see more than 4 companies with key insiders selling for everyone with buying. And in Canada, it's a little bit better than that, but the trend is still been down. They've been doing this now for some time. It hasn't just been in response to these recent headlines. Your listeners may have heard about Turkey and Argentina. They've been doing this now for a few weeks and months in advance of this. So it is more than just this sort of off in the distance noise you may hear about emerging markets. In our view, it relates to risks right here in North America in terms of what central banks are doing and what's going on in the background. So it's important not to get complacent to saying, well, North America is doing just fine, and everything seems to be doing okay. That may well be the case, but the question is the risks that are unfolding underneath the surface, and whether stock prices have fully been discounting those risks, and insiders are saying at this point, probably not.
We'll have more with Ted Dixon next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're talking to Ted Dixon. So often people say emotions, sentiment rules the markets. When things get high and things get slippery, we get all panicky. Yet, we've had calm people telling us for a year and a half, look out, the equity market is overloaded, it's going to slide. Why don't we pay attention to that?
Well, equities are driven a lot by sentiment, and the fact of the matter is the United States, it had a great year in 2013. So the bears were early, and there's nothing to say that sentiment can't keep going in 2014. We just don't know. So we're kind of in a very foggy situation, and a lot of times in the fog, people go by feel, and that's the case in investing. And right now, insiders aren't feeling very good. So there are exceptions, as we said before the break. And in Canada, the two areas are contrarian areas, where investors generally don't feel very good, and that is in gold stocks, which have already taken a big beating over the past few years. So they've got a lot of bad news already incorporated into their prices, unlike the U.S. equity market, which has basically got a lot of good news priced in. And the real estate investment trust, which took a big hit earlier in 2013 on rising rates. There's been quite a bit of insider buying in Canada in selected names, and you can go to inkresearch.com and we provide a list of those companies that have seen insider buying and REITs of insider buying, and there are other services out there that talk specifically about real estate area or gold mining area. A lot of good gold mining newsletters out there, but in general there are opportunities. They're usually in areas that general investor sentiment is not very positive on, and it's because prices have been falling, and usually you want to buy low and sell high, and so when stocks are out of favor, it's a good time to go shopping. It doesn't mean that things are going to bounce back up immediately, but if you're looking at investing as a business person, you want to buy an asset that's got a good upside potential but is underpriced. And right now in the equity markets, there are few broad areas where that is available. And in the U.S., from an insider sentiment perspective, the area that is the most loved by insiders is utilities, which is probably you don't hear a lot about on talk TV, and you don't read about that in the newspapers a lot. You tend to read more about technology companies and social media companies, but utilities are.
When you say utilities, I mean there's nothing sexy about sewer, water, and electricity, really, is there? It's
right,
but you just need them.
Right, and no matter what the Fed does, you're going to need them. Then the question is, for these organizations, what's happening in the bond market? Are interest rates skyrocketing? And provided that interest rates behave themselves on longer-term interest rates, these companies tend to do okay because their input costs in terms of financial costs are low. So basically, what insiders are saying in the U.S. is the risks are high, and this economic U.S. recovery that we just had GDP numbers this week in the U.S. at initial read, and these will get revised, but came in kind of as expected, and you'll get commentary on both sides saying, well, it's actually better than expected. Well, no, it's actually worse than expected.
Better than worse. Yeah, the very worst scenario, we were hit by an asteroid. So this is better.
Right, and there's all sorts of people reading in one way or the other, but what insiders are in the U.S. are signaling, is basically, economic activity in the U.S. is probably peaked for the time being. So how's that going to weigh on this market sentiment if economic numbers start sort of coming in softer over the next year? And also, again, we come back to the risks. I've said this over and over again in this interview, but the next couple of weeks and months are big experimental months in the U.S. Financial markets, and it's very limited history that we're working with, and every time that the Fed has tried to pull back on QE, the markets have gone down, and so we will see if it's different this time. But insiders are not taking that risk.
Is the U.S. trying to copy the Japan way of doing the new economy? I don't know how else to put it, but they said Japan has a big economic theory that no one's ever tested out for real. Is the U.S. doing the same thing?
Well, it's an interesting dynamic between the U.S. and Japan. The Fed wanted to avoid getting into a deflationary trap. So they kind of wanted to avoid Japan, and then Japan kind of thought, well, we got to get out of this deflationary trap. So let's one up the Fed and learn from their experience. So there's kind of a competition, I would say, a healthy competition in the sense that you want policy makers to be trying to learn from other mistakes and other things that work. So there is a definite dynamic, I think, going on between the Fed and the Bank of Japan. And certainly last year, American stock prices behaved positively, and Japanese stock prices behave positively. But we'll see what happens this year, particularly in the U.S., where you have the Fed reducing its amount of bond purchases, and in Japan, the Bank of Japan is continuing its asset purchases. So we do have a divergence between the paths. Now, in the U.S., they've been targeting unemployment. Unemployment has been falling, some for good reasons, some for not so good reasons, because a lot of people have been leaving the workforce. But they've got to now pay attention to inflation. Consumer price inflation's been falling. This is something that bankers don't like to see. We'll have to see if inflation has bottomed in the U.S. It would be positive for the mining sector. If it has, we'll have to watch carefully how the U.S. central bank responds should inflation resume a downward trend, because they're pulling back on quantitative easing. I don't think that's a bad for the mining sector, because it hasn't really helped them this last round of quantitative easing. If anything, as the Fed keeps loading up their balance sheet with more reserves through this money printing, it puts kind of a upward pressure on short-term rates, because they have to pay interest on these reserves, and will have to. They've chosen to pay rates on these reserves, and they're above market rates. So there's an odd dynamic that goes on. Again, we're in very different times in terms of monetary policy, and we're trying to end a grand experiment. So this is going to be very interesting, but it also could be very risky. So we'll see what happens. And insiders just are not into putting a lot of new money into the market right now, except in selected areas. And gold stocks are getting some love. REITs are getting some love in the U.S. Utilities are getting some love. And for those who have a bullish outlook, the one area in the U.S. that is kind of standing out as the big hope that this is all going to work out quite well is in the banks and the financials, where insiders tend to be even on an even keel here. They're not overly excited, but they're not overly pessimistic either. So there is a glimmer of hope that this could all work out, but keep your eyes on certainly financial stocks, particularly in the U.S. over the next few weeks. See how they respond. Take a look at insider activity in the financial area. If it picks up, if on times when the market sells off, then that could suggest that these are buying opportunities that are coming up. However, if the insiders stay on the sidelines, particularly in the banks and the financials, then you might want to consider staying on the sidelines as well if the market's going down.
Ted, is there a website someone could go to take a look at your point of view on what's going on?
We provide a daily newsletter and a weekly market commentary via inkresearch.com. That's inkresearch.com. And you can get a free look at insider activity by visiting a site called insidertracking.com, and that has both U.S. and Canadian insider activities for Canadian and U.S. companies, and that's free for all to look at, no charge.
Thanks to our guests, Ted Dixon and Ross Clark, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.